So in this video, I'm gonna be discussing some of the biggest risks of not investing, right? Because I know for a lot of people, like if you're someone that's thinking about investing, a big reason why a lot of people don't invest is obviously because fear of losing money, and also a lot of people think the game is rigged, right? And these are two like legitimate concerns, right? A lot of people don't, of course, most people don't want to lose money, and people think that there's no point in trying because they think the game is rigged. And and I understand, but if you're someone that's looking to build wealth or hopefully looking to retire, like sometime obviously when you get older, then you need to understand that you need to start learning how to invest, right? Because let's be honest, like relying on active income alone is not gonna get you to where you want to be financially. Like, right, if you're someone that's looking to retire or you're trying to build wealth, active income alone is not gonna get you there. And when I mean my active income, obviously is active, like the amount of effort that you put into actually making money. So if you're working your 9-to-5 job, you get paid based on the amount of hours you work. So you're gonna have to figure out a way to not only make active income, but you're gonna have to figure out a way to make passive income. And one of the best ways to do that is through investing. So in this video, I'm just gonna go over like some of the things, like some of the biggest risks of not investing, and then also like go over some of the fears that a lot of people have and how like to overcome them. So what are some of the risks you take when not investing? And keep in mind, like when it comes to investing, like we know there's different ways of investing in terms of like real estate or maybe starting a business, art. But in the case for this video, we're gonna be just talking about the stock market, right? So one of the biggest risks when it comes to like not investing, especially when it comes to the stock market, is lost growth opportunity, right? One of the best ways to build wealth over time, especially passively, is through the stock market. And one thing that you miss out on is having that money grow. Like if you're investing money into the stock market, the ability for that thing to grow and earn compound interest, right? So that's money, your money making money on top of its money. Right, so you put money into the stock market, and over time, you earn certain probably interest on that money, and not only that, but you also earn dividends depending on the stock that you invest in. So all that money that's being accumulated, and assuming that you also reinvest your dividends back into your portfolio, all that money is being compounded, making more money over time. So if you're someone that's not investing in the stock market, you're missing out on that potential growth opportunity. And then say over 5, 10, 20, 30 years, depending on how much you consistently invest, you could be sitting on top of at least $1 million plus, depending on how consistent you make. So that you could use that money to then build wealth over time, to do other things, and also especially retire. So I think for a lot of people, like one of the biggest opportunities that you miss is having that money grow over time, and that's money that you don't even have to like put in any effort. All the most you're doing is just taking your money from one bank account and putting it into your portfolio, and then having that money grow. Now, the second risk that you're taking by not investing is inflation, right? And we all understand what inflation is. It's basically your dollar having less purchasing power over time. So let's say you have $1, and that dollar used to be allowed you to purchase like 4 apples. Now a year later, that same dollar can't purchase 4 apples, and you can only buy 2 apples with that, right? So things are becoming more expensive, and that dollar is losing power over purchasing power over time. And usually, typically, like inflation is around 2 to 3%. So you want to make sure that you're able to keep up with that. And if you're someone that's just we're relying on your active income, and you're just keeping that money into let's say a bank account, a savings account where you're not earning any interest, over time your money over time is losing purchasing power. So you need to find vehicles investment vehicles that's going to help keep up with inflation. That's going to earn you at least a 2-3%. So your money's not being devalued over time. So that's another risk. If you're not investing in, and usually like depending on what you're investing in the stock market, if you're to say you're investing in index funds, you can earn, over time, if you look at history, it earns you anywhere from like 7 to 10%, right? Which is much more than what inflation is. So you want to make sure you take advantage of opportunities like that, because it's very important to make sure that your money is not losing value over time. Now, the next thing is obviously limited retirement funds, right? I think we have a tendency for a lot of people like rely on Social Security, right? We work for 30 years, and we're like, all right, we're gonna rely on Social Security to get us through the rest of our life, which is the wrong attitude to have, because Social Security is not meant for you to live on. It's just supposed to be a supplement, but a lot of people rely on that. And then you can see how you can look in the news where a lot of people are talking about, for certain people, I know especially for me, I'm not expecting it. Like I expect that thing to be like there needs to be no money left left when it comes time for me to retire. But for a lot of people, even baby boomers coming up, a lot of people are talking about, like, in the next 10 years, there's not going to be any money within for Social Security. So a lot of people worried about that, and if you're someone that's relying on that, that's a huge concern. So that shouldn't be, relying on Social Security shouldn't be your strategy when it comes to retirement. The earlier you invest, and especially the earlier you invest in the stock market, the larger your nest egg is going to be by the time you retire. So you want to have to keep that in mind. And also financial security, like knowing that you're investing in the stock market and investing in the long term, 10, 20, 30 years down the line, when you're ready to retire, then you can have a nice lump of cash for you to just live off till you die. And that's what people need to really understand and really need to focus on, that you can't rely on Social Security, because there's no guarantee that Social Security is going to be there, especially the way our politicians manage the money. You have to take that, your retirement into your own hands, and you miss out on that opportunity if you're not investing. If you're just relying on that active income, and then hopefully security when your time to retire with Social Security is gonna get you through, that's just the wrong strategy to have. And lastly, missing out on potential income, right? Not only does your investing in the stock market, not only does over time does it build value, but there's also an opportunity to make income, right? And that's through dividends, right? And dividends is pretty much basically is profits that are shared. Like a company shares its profits to its shareholders. So whatever profit they make, they pay a certain dividend. Depending on the company, it could be anywhere from 1 to 8% for the year. And this is income that you could, some people, depending on your investment strategy, that you could live off depending on how much money you invest. So over time, like if you're someone that's investing early, that you could build up that dividend income over time, where you could get to a point where you're living off that dividend income. So this is also a missed opportunity to be able to make passive income through dividends. Some people take that dividend income and reinvest it, which is a good idea, especially early on. But especially when you want to retire, or maybe later on in life, you can actually live off that dividend income. So these are things that you need to understand. Like by not investing, these are things that you miss out on, like basically lost growth opportunity, inflation, limited retirement funds, and also missing out on income. So these are things that you need to keep in mind when you're saying, I don't want to invest because the game is rigged, or I'm afraid of losing money. These are the risks that you take by not investing. So now let's go over some of the fears and how to overcome them, right? We already talked about how obviously one of the biggest fears is losing money. And the reason why people are afraid of losing money is because of the volatility in the stock market, right? When people see that stock market go up, they can see it go down. It gets a lot of people scared, and it's like, oh my God, I put $1,000, now it's down to 500. So it gets a lot of people afraid. But one thing you need to understand is that that's just the way the market works. It goes up, it goes down, and you need to understand that. So that's why it's important to educate yourself, right? How you overcome that fear is basically by educating yourself and understanding your risk tolerance, right? Like how much can you tolerate understanding that the volatility of that market. And you do this by educating yourself and understanding that the market is going to go up and down. But remember, when it comes to losing money, you may lose the value of the value of your portfolio may go down, but understand that you don't lose money unless you take it out the market. Right, and I learned that firsthand. But back in 2020, when I started getting into investing, and the pandemic happened, right? I saw the market drop. I took my money out, panicked, and lost some money at the time. And eventually, I put it in back later and made some money. But once you're new to this, you're not educating yourself on that. You don't really understand your risk tolerance. It's important to It's important to really understand yourself and how much tolerance you have towards that risk. And if you're someone that's afraid of that, then make sure that you have a percentage allocated to the stock market. So let's say if you make $10,000 a month, just allocate a certain percentage, anywhere from 1 to 5%, and be able to allocate a certain percentage that you're not afraid of losing. So let's say you put 1% in, and you're not afraid of losing that 1%. To say the stock market goes down and you lose all that money, at least you'll be able to sleep at night knowing that it didn't wipe you out. And I think that's what you need to understand. Allocate a certain percentage to a point that you're not afraid to lose it, and I think it'll allow you to sleep better at night, knowing that. Also, understanding that investing is a gradual process, right? Like if you're investing, you need to understand that this is a long-term thing. Investors think long-term, right? Unless you're a day trader that you're doing everything by the day, you need to think long-term, 5, 10, 20, 30 years from now, right? So it's not something that you make money right away. This is a process that takes time, and as long as you understand that, you don't have to worry about the volatility of the stock market, right? Whether it goes up or down, all you need to understand that over time it will eventually go up. And that's the next thing is like understand that the stock market has a 100% track record of recovery, right? Regardless of how much the stock market dipped, it's, if you look at the trend, it's always gone up, right? It's always recovered and it's always gone up. So that's why it's important to understand that, understand the history of the stock market, and know that even though you'll see the volatility, you see that the market dip 20%, you know over time that it will eventually go back up. So that's something like really understand. A lot of people are like, they see that and they get fearful and they say, oh man, I don't want to lose this money. But if you looked at the history, especially depending on, let's say you the S&P 500, you see over time that thing has always gone up. So how do you get started? So let's talk about getting started. So basically when you're getting started, you want to make sure you set clear financial goals, create a budget, right? You want to make sure you create that budget because that's important to understand. Like I said, allocation, whether it's going to be 1, 2, 3, 4, or 5%, make sure you create that budget and say, all right, I'm going to allocate a certain percentage every month into the stock market, right? Once you do that, then you can say you have a plan and you know exactly how much you're going to be investing into that stock market. Next thing is also you want to build an emergency fund, right? Because when unexpected things happen, you don't have to just say, oh, let me dip into my portfolio, like my stock portfolio, because I got to pay for this emergency. You don't want to do that. I've done that before, and it's the wrong thing to do. That's why it's important to build that emergency fund, so when emergencies do happen, then you can take that money and then handle that emergency instead of dipping into your portfolio. So make sure you got that emergency fund settled. Another thing is also you want to explore like different investment options, right? And if you're uncomfortable when it comes to investing, then it's okay to seek professional help just to get some advice and like give you a clear plan of what you want to do. Educate yourself on that. So that's also important. And also you want to make sure you start investing early, right? So you want to make sure you start early and then do it consistently. Right? You don't want to just be like, let me invest $1,000 and then just set it and forget it. You want to make sure you're doing it consistently. And like I said, as you allocate a certain percentage, then you want to make sure you're putting that money into it every month, every week, whatever you plan you set for yourself. And then if you get more comfortable, you want to increase the allocation from like 1 to 2%, 3%, 4%, then you can do that. But make sure you're doing it early, and then you make sure you're doing it consistently, right? And then once you do that, then you should have a consistent plan, and you'll be more comfortable when it comes to investing in the stock market. Because like I said, you can't rely on the active income alone. That's not, especially not in America. You're not going to be able to just get it done on active income alone. You're going to have to find a way to make your money work for you, right? And multiply that money. Whatever income you got from your current job, take that money and have it multiply. Right? And that's the most important thing. So once you do that, you have a plan, then you won't be afraid of like how the market works. Because we see over time that if you're looking to build wealth, investing in the stock market is one of the best ways to go. Right? So that's all I got for you guys today. If you got any comments or questions, make sure to leave it down below. Hit the like button and share. And if you haven't done so already, make sure to subscribe. Right? So you guys take care and have a good one. Later.